Hey, good afternoon. Welcome to the FedEx earnings live stream. I'm joined by Daryl, who is going to handle the charts, and I'm going to handle the fundamental evaluation of FedEx. And toward the end of the stream, if you want to talk about other stocks, that'd be great. But for now, we're going to talk about FedEx for about 10, 15 minutes. And then we're going to listen to their management speak. And then we're going to come back and comment further on FedEx. How you doing, Daryl?
Doing wonderful, Victor. Good to see you. Hello, everyone.
Good to see you. And I've been looking into FedEx today, just get myself ready, and I've updated my valuation based on the earnings that were just released. I'll do a quick overview of their earnings, what I drew from the earnings report. I'll show you my evaluation, and then we're going to let Daryl kind of look at the charts and then make our way over to the earnings call. Thanks so much for Jumper Guy to join, and thanks for tuning in. It looks like FedEx reported a positive report because their stock was trading higher. Their revenue grew about 3%. If you look at top line growth, that's pretty decent. FedEx is not in a boom economy. They're also dealing with Amazon's doing a lot of their own shipments, and some factors around the economy are taking away volumes from them, but they're doing a pretty decent job of preserving their revenue and growing a little bit. Looks like their cash flow was higher than I had been seen before. The trailing 12 months cash flow went up higher. That doesn't give me a whole lot. I already read the earnings, so I'm just going to flip here. And so that was positive. The free cash flow number was positive. The earnings I thought was good, that, hey, just stay on track. You're a slow grower. I don't think anybody's expecting you to be a high grower anytime soon, and maintain your profitability. The stock is trading up 5.73. The stock over the last 5 years, it's barely, it's you're down 7%. I guess if you measure the dividend, maybe you're close to even, but it hasn't been a real winner. And over the 1 year, it's sold off 23.66%. So the market, it hasn't been overly excited about FedEx. When I look at the stock, I took their financials into consideration and I updated my valuation. I'm coming up with a 34% discount on FedEx. I'm using a growth rate on their cash flow of 5%, using their trailing 12 months, which is updated with today's information, as well as their debt and cash, using a discount rate of 8%. And based on cash flows, they're discounted by 31%. Earnings per share also provides a discount. So that's a pretty good discount there. I'm using a P of 18, and I looked at their 10-year average. It's actually about 34. So 18 is I think a PE ratio that they deserve, because it's a really well-known company. I think it's lower risk. They are growing a tiny bit. So 18, I think, is appropriate. Compared to UPS, which is their peer, UPS is also presenting a pretty good discount. UPS has been on a long downward trend for a long time. So I think this space provides a couple of good options within, the shipping and parcel delivery space. A 34% discount on FedEx, as well as UPS is discounted. Now let me turn it over to my colleague here and see what the charts are showing on FedEx.
So we can see on the intraday chart in the aftermarket, they are trading as high as 241 at the moment. These are 5-minute bars. Then if we look at the 1 year chart for FedEx, they have been on a pretty long decline. We could draw a line across here, connecting the many tops as we can, and it looks like they will have broken out. If these prices hold tomorrow, they will be above this downtrend line. So that would be somewhat of a welcome change in this. I have a bug flying around here. I apologize. It looks like I got something going on here, but it's just a bug. They do have a declining 200-day, so that confirms that they're definitely in a downtrend. the 20-day, it looks like they're trading above that. It has been declining, and the 50-day is also declining. They did have pretty high volume today, and yesterday they were above average 50-day average volume. They did trade down yesterday, and they traded up today on about, looks like about 2.5x or maybe 3x volume. Going into the earnings call, they were at an RSI just below 50, so they were showing some weakness, although Victor has a what is that called? Poly
market.
Market, yeah. The markets seem to be leaning towards a beat. The charts that I look at here were showing it was kind of just in the middle of the road. It wasn't showing really much strength or weakness. And the PPO is pretty much flat. We can kind of tell that by the pricing. It hasn't really gone up or down since the 7th of August or so. We had a bit of volatility here. The accumulation, we had a peak accumulation in this 1 year time frame back last year, and since that time it's been below that peak. It's flattened out from about March until September, and March until August, let's say, and the accumulation it's actually been in distribution mode. The money flow is negative at the moment. When we compare it to the S&P 500, it's underperformed by 34%. It's underperformed the industrial group by 33%. It's outperformed the delivery services by 1.707%, and delivery services has underperformed the S&P 500 by 34%. So the industry's struggling, and FedEx has also been struggling within that industry.
Now, you've been following the economic data and reporting it really well, so thank you for doing that. Let me ask you, because FedEx and UPS will basically get their volumes from an expanding economy, and the latest and greatest is the jobs numbers look pretty good. And the economy, I don't think we're in recession. We just had a lowering of interest rates. So just kind of big picture, do you think the economy is setting up for it to help FedEx, or not really help them, or the latter hurt them?
That's a good question. I would fall back to maybe looking at the major indexes. So I'm looking at a 3-month window here for the transportation average, which I would presume that's where they would be in this group. And over the last 3 months, they've been lagging. And I bet if we go to year to date, they're going to be lagging as well. So 6 months, they've gotten a little bit better. They're still lagging the other major indexes. If we look at a 3-month window, they were the same as they were 6 months ago. So no real improvement over the last 3 months. So I don't know if they have a lot of, if I'm seeing many signs for helping them grow at the moment. And that may be one of the reasons they have that cost saving program in place and driving that so heavily.
Yeah, it's going to be a slow grower, and I'm not sure that we're really celebrating these really, really high growth stocks. But look at this here. The stock is up 6.58%. And I think it's part of the reason is that the news has been so bad with the stock. It's been selling off, that if they're showing some growth, the growth is better than it has been doing over the last couple of years. You see the quarter that they closed prior to the one they reported, they barely grew. Now they're growing at like 3%. That is good news. And if you look at 2023, for fiscal year 2023, ended May 31st, their business actually contracted. And then it contracted when the year they closed in 2024. And they just barely grew for the year they closed on May 31st, 2025. So for the first quarter of the new fiscal year, getting off on the right foot and growing 3% is encouraging. And I think that's why the stock is up. Look, it's up 7.5. So this thing has been sold off. I imagine some maybe older investors hold FedEx kind of in good regard because it's been a trusted company for a long time. For the most part, FedEx has been a good operating business. So has UPS. And if there's an opportunity to buy one of these brands that is part of like the economy that it's going to be around for the next 20 years, it's not a bad idea for the investor that maybe doesn't like risky stocks, like the small caps around tech. Maybe they're like, hey, FedEx, that's a pretty good idea. I can earn it a dividend at 2.57. And this stock has been sold off, so it doesn't look too expensive. You're getting a PE now of 13.43 and a forward P of 12.37. That's not bad. And I showed you where historically the PEs have been much higher on FedEx. So it's not a bad idea for an investor that is looking for some stable stocks that are lower risk. It's not going to double, in the next couple of years like an NVIDIA, but it's looking pretty good.
I have some data here on the last 4 earnings.
Mm-hmm.
So basically on September the 19th, when they reported, they missed on revenue, missed on earnings, and the initial reaction was a decline of 15%. The following quarter, they missed on revenue, beat on earnings, and they were down 0.05%. Then in March, they beat on revenue, missed on earnings, and they were down 6%. And then this past quarter, they beat on both the top and the bottom. And the initial reaction was down 3.27%. And here's their revenue estimate and earnings estimate. And when I calculated the implied move, it was plus or minus 8%. And from what I saw in the pre-market, they're going to be testing the upper edges of that.
Yeah, we're at plus
move.
8% right now as you speak.
Yeah. So I thought the history was kind of interesting.
Yeah, it certainly is. Yeah, FedEx and UPS are pretty darn stable. And, it's not going to be, one of these stocks that has, what is their beta 1.21. I guess since it's been selling off, there's higher beta than I would have expected, but I would expect that it's near 1, maybe even below 1, but maybe historically it was a little lower.
And they were downgraded as recently as just yesterday by Evercore.
I wonder what's going through the minds of that analyst. He downgrades it, and then the next day it goes up 8%.
Yep.
Oops.
Yeah.
I was just kidding, everybody. Anyway. All right. So we covered FedEx, and, I think I got the timing wrong on the earnings, because the earnings, according to their website, aren't going to really start. The management's not going to speak for another hour. So I don't think we're going to be waiting for an hour. So we can move on to other stocks and maybe other news that came out. It looks like Mike is on. Brandon is on. Good to see you. Saeed is on. And Mike, I agree with you on your earlier comment that I think the decision for Amazon to move away from UPS and FedEx and handle their own shipments, that's going to be a big factor that they're going to have to figure out. But I think there's a lot other volumes they could be shipping, right? Like Amazon's not going to ship for business to business, like if a supplier sending packages over to another, business, that kind of volume should stick around. Yeah. All right. Looks good.
They are separating off their freight division
Mm-hmm.
next year. So that's their less than truckload division. I think they had retail sales of about 8.9 billion, which is the smallest of all of their divisions. But that's going to trade under FDX,
Right.
I think, or something like that. But anyway, that's supposed to happen in the middle of next year, in June of next year. So I know a lot of people follow like Old Dominion and some of the other less than truckload companies. Maybe this one will be one to add for next year on your list.
Mm-hmm. Yeah. And one last threat, that FedEx and UPS will have to deal with is, I know that like Uber, and I would just say gig workers, you have some local suppliers, especially in like big populated areas, densely populated, where they're like, yeah, you order off my website and I'll, put the product in an Uber or an Uber like service, and they'll drive it over to your home, right? And same day delivery. Well, that's pretty darn attractive. And that would take one shipment, every time that happens, it's a shipment that's taken away from FedEx or UPS because it went through an alternative delivery mode. So I think that's going to continue to grow because, online just keeps growing. And it seems like, especially Amazon keeps pushing the envelope of, order something, you got it the next day. I ordered something yesterday, and for not much more, it's going to be delivered today. And I remember back in the day, like 30 years ago, if you wanted it the next day, you were going to pay through the nose. You were going to pay some big dollars. Now it's like, no, you'll get it to you the next day. No problem. All right. So looking around the rest of the market, can we move off FedEx or anything in the last comments on FedEx?
Nothing further from me.
Okay. And the market today traded up, and small caps had another really, really good day. I know a lot of my small caps are just flying up. Great to see. And some other stocks like Intel was up 22.77. Palantir was up 5%. CrowdStrike was up 12.82. They had an investor day and they're very optimistic about their future. Synopsys was up, and so was I think what's that other company in there? Anyway, that space was up big time. I started buying shares of ASML. Those shares were up like 6-7%. Applied Materials was up. Just a lot of stocks were going up. The big guys, they were kind of, they weren't having the biggest, best day out there. Amazon was down a tiny bit. Tesla's down. And so it was a day with, if you're in the right stocks, you had a really, really good day. And those small caps are what was really, really productive today for investors. And any highlights from today you want to mention?
I'm actually running a 3x leveraged TNA call. I started that in the 5th of August. So I was in at about $35 on that ETF, and it's up around 30% since August.
Oh, that's great. Yeah, I think the month of probably the last 30 days, let me take a look at so if I look at the Russell, so the 1 month looks good. 7.55. And I'm playing around with my new beta Google Finance. But that's pretty good. I don't think it's kept up with the S&P for the year. It's still lagging it. So if we look at the 1 month, the Russell is beating the S&P for the 1 month, but once we go to year to date, it's almost there. It's almost caught up with it, but the S&P is kind of going to beat it by a little bit. Yeah, the S&P is doing 12.76% year to date, and the Russell's up 10.65. But it's all about, like, the Russell has so many stocks that if you're in the right stocks, you're seeing year to date 100% appreciation in many cases. I think Mike's mentioning one small cap that has been moving is Monday. Monday's been certainly moving. It had a very, very good day today. And this stock came up about a month and a week ago. A member brought it up, and I looked at it and it looked pretty darn good because their financials, very good growing business. It's pretty sizable now, 1.1 billion. It's a software play. So these software companies, they make plenty of money. This one makes 89.42% gross margins. They're small, so they're not incredibly profitable, but as they get bigger and they have to spend less money on research and development, creating their software and so forth, these guys are just going to drop a lot of that profit down to this line. Their free cash flow looks really good. So it looked really good about a month ago, and I jumped in, and I am glad I did so. I'm up 15 to 17% in just 4 weeks. Wish they were all like that. So that was Monday, a good one for today.
I see some all-time highs are being shared in the chat. I can run a scan here and tell you how many were in the S&P 500 today.
Uh-huh.
So let me we'll do new 52-week highs. So I'm looking. Oops, I didn't want to do that. I'll just run a scan here and it'll tell me. So it looks like there were 450 new all-time highs. This is going to include ETFs as well.
And this is 450 out of the all stocks?
Yes, this is all stocks. So
it's still a big number.
Very
big number.
Let me see if I can narrow it down for just like the S&P 500.
It looks like SoFi is at an all-time high. Incredible.
Okay, so let me take out ETFs, and I'll just do the S&P 500. I got to take that out as well. That can't be the S&P. Oh, this is including industry groups as well. So I'd have to fine tune that scan. I was just trying to run this. I have an easy scan that I use, but it's limited to just my portfolio, so that wouldn't be very helpful for us. Portfolio, new week highs, S&P. Yeah, I don't see. Well, here we go. S&P 500, new 52-week highs. This is the 15. That was weekly lows. That's not what we want. Although that could be interesting to look at as well. 52-week highs. Let's try that. There we go. 131.
Wow. Out of 500.
This is 1,500.
Oh, okay. 1,500.
This is the S&P 1,500.
So less than 10%, maybe about 8-9% of companies are at all-time highs.
Yep.
All right.
AbbVie was one of them. That's one that I own.
Yeah.
Allies
Awesome.
of Allies of Bank.
Citigroup. I own
Citigroup.
Citigroup.
Yeah,
Yeah.
Citigroup we own. Caterpillar's up there.
So the expression, it's you got to stay invested for the most part, and this is why you stay invested.
Yeah. Here's Google.
Yeah, very good. Go
Yeah.
Google.
Yeah. JP
GE
Morgan.
Aerospace was up there. JP Morgan's a big cap. Macy's
Medtronic.
is
I
at an
haven't
all-time
seen them
high.
there. Yeah.
Really? Wow.
Seagate.
Yeah, we looked at that stock
We've talked about them a couple of
not
times
too
this
long ago. Yeah.
past couple of weeks. Western Digital is one of their competitors,
Mhm.
and they're also at all-time or new all-time highs, or 52-week highs at least. Anyway, stock charts makes it pretty easy to run those kind of scans.
Right, right. All right. So if there's any stocks that you guys want us to take a look at, I know we've got so Finvolution's come up. Let's take a look at Finvolution because that one's like a lesser known name. Be interesting to take a look at. Finvolution's a Chinese financial services company. And what has it been doing for the last month? It's been selling off. It has good fundamentals, but the and I don't know if how do best go through a decision process because there's some small caps in China where the fundamentals look good. Like Finvolution is the stock we're looking at this moment. And in the Discord, what was the stock that came up on the Discord? It'll come to me. And that stock also looked good. Now, these are hard for me to kind of get my confidence around them because it's way over in China. It isn't growing all that fast anymore. So these small caps are kind of, to me, they're very risky. But boy, if they start to work, I'm going to feel like, oh, I kind of lost one there. I know Futu's really worked for me. And that one was quite small when I started buying into it. I think it was well below like 10 billion in market cap. Now it's up there quite a bit. So these here, Finvolution has the fundamentals to potentially really go up. Let me take a look at their valuation. Yeah, I think it's discounted by like 70%. It's a very discounted stock. And if the market gets excited about it, it could really go up. $2 billion market cap, it could really jump up. It's just that's really taking a higher risk than I want to at this moment. And
QFIN may have been the other one you were talking
yeah,
about. Yeah, I
that's
just
it.
looked in our Discord and found it for you.
Thank you. This is the one that was brought up today. And the investor that looked at this, he's actually from Poland and he did all the analysis. He did a nice job. And this thing is super discounted. The fundamentals look really good, but I'm back to, boy, these are just not household names, right? It's not like, oh, here we go. These are well-known names and easy to get our heads around. No, they're way on the other side of the world. And I'm not sure if they're going to be a wild success or going to peter out. And then my capital is going to be trapped. So maybe these are worth the risk. Maybe just adding a little bit of capital to one or the other might be a good idea if an investor is willing to take the risk. So that was Finvolution and QFin. Looks like Brandon, you want to look at NRDS? So NRDS, NerdWallet. So this one was up a little bit. How's it been doing this year? It's down. So these guys, I'm not quite sure what their business is about. It's like so they have a digital platform that provides financial guidance to consumers and small, medium-sized businesses in the US, United Kingdom, Australia, Canada. Okay. Okay. So I imagine they're getting a lot of, affiliate kind of compensation when they take one of their customers to one of those sites. And how has their stock hasn't been doing great, but has their business been growing? Looks like good growth. So good growth even in the quarterly. So that looks good. Looks like they're going to be very profitable on the gross margin line. So gross margins are terrific. Free cash flow looks good. The S one's looking good. It looks like a good fundamental company. They make a lot of money. They're growing. They have 5 analysts covering them, and the analysts think it's discounted by 22.34%. The worst price target is $11 per share, and they're just slightly above that. The best price target, 17. Now, the growth, the forecast is that they're not going to grow very fast. They're actually going to flatten out here. So that is a little bit of a concern. They don't have a lot of excitement. If they're growing at mid 20s and they're going to stay growing 20, 25%, even if they can accelerate that, then we're talking. They still have really good fundamentals. Yeah, I'd like to do the valuation on this one and see where we land and share that with you guys. Do you have any charts on NerdWallet?
Yes, I do.
All right, why don't I turn it over to you and I'll do a quick valuation.
It does look like over the past year they're in a primary downtrend. The 200 days been decreasing all year. When I step back a couple of years, looks like they pretty volatile at times, and then when they regain their composure, they stay pretty flat for long periods of time. I see a pretty flat period from November through middle of February this year, and then once again after we come out of the COVID announcement lows, it looks like they flattened out and have stayed flat since about the 15th of May, where most other companies that we've looked at here recently have regained their highs. So this one is traveling sideways. Let me go back to 1 year. The 200 days declining. The 50-day looks like it's declining. The 20-day does look like it is turned upward, and it looks like it crossed over. Let me go and add my zoom thumbnail so I can see it better. It crossed over the 50-day moving average, so that looks pretty good. The RSI is sitting above the midpoint. It's currently trading at 60. PPO is positive above the midline, so it shows that it's bullish at the moment. It's currently has higher relative strength and higher momentum, so it is in the leading quadrant just barely at this point on the relative rotation graph. Accumulation has picked back up, so even though it's been pretty flat here for the last few months on this big drop, it looks like a lot of people stepped in and purchased, accumulated a lot of shares on that big drop. So that shows some positive sentiment to me. They have underperformed the S&P 500, underperformed technology, outperformed the let's see, that's underperformed by 29%. The software industry and the industry is outperforming the S&P 500 by 5%. So one positive sign I see is there seems to be good support right around here at $10, because the sentiment really jumped when it hit that price. People were willing to step in and spend some money to get back in, accumulated a lot of shares.
Yeah, and this is a small cap. It's not a lot of shares. So,
Yeah, they're trading, looks to be about 5.3 million is their 50-day moving average. Their daily is 420K. So they're not moving many shares per day compared to a lot of stocks we look at.
yeah, let me finish off my valuation. And as expected, this is looking discounted because the numbers are good, the growth rates are good, and the market cap is really low for the company. The earnings per share was 72 cents. This is a growing business. It's a small business, but unfairly, it'll give them an 18 and expect that they're going to grow that by 10%. So it's a nicely discounted stock. I mean, it's a nice, it's a consumer facing stock. You know, these tend to have a desirable customer list, and they tend to get acquired. And, you know, maybe another company feels like, hey, we can market to the NerdWallet customer. We can market our other products. It's very valuable to have that many relationships of consumers using NerdWallet to manage their finances. So it's a pretty good looking company. It's discounted. If we're very conservative with the growth rates, 10% here, 10% here, it still shows a really strong value. They have nice cash on the balance sheet, no debt, literally. Looks good. NerdWallet is discounted. And, you know, within that space, I can't say that, you know, a couple companies in that space are really flourishing, like, you know, SoFi was mentioned earlier. That's doing really well. Robinhood's been doing really well. Coinbase had a great day, but I can't think of another company that competes against NerdWallet. All right, and I will just update this briefly and then get back to looking at the next stock. All right, there was another question. I think, let's see here. So we did talk about UPS, but we talked about FedEx and we talked lightly about UPS. I can cover that again. So UPS is benefiting from the positive earnings on the FedEx side. FedEx is up 6.4% in after hours. And it looks like UPS is catching a little bid here. It's up 2.7%. This stock, when you look at it long term, man, look at this. It's just been selling off. And this is rational when you look at how their business has, you know, played out over the last 5 years. We were hit with COVID. Everybody was ordering stuff. It was getting delivered by UPS, FedEx, and their revenues went up 14%. These guys were not growing that fast before, and then they grew another 15%. Well, once everybody had all the stuff they wanted and they stopped ordering stuff, their business contracted. And then from there, they haven't been able to grow. The last couple quarters haven't been good. They're still contracting. But I look at this sell-off in the stock and I'm like, man, this might be a good opportunity because it's UPS. It's a very, very good company. So this one here looks pretty, I don't know, if they start to grow, I think this stock's going to move. And it is a discounted stock.
They've been around forever too.
Yeah. And I think they've been around for like 100 years, right?
Yeah, I thought they started around 1909 or something like that.
Yeah, that I think their business started in Seattle, and from there they grew. They grew their network, and here's the valuation on UPS: 38% discount, solid business, looks good, and so's FedEx. I mean, FedEx is going up quite a bit in the after hours, so this is probably going to turn into a 27 or 28 discount. This one's probably going to turn into a 35 or so. These are good businesses, but they're not going to be, like high appreciating stocks like a SoFi or or a Robinhood. They're going to be a good, safer stock. These guys are going to probably operate quite well. If you had a 10 to 15% rate of return on these, I would be happy because you're taking a lower risk. These are very well known companies.
And UPS has a dividend yield of 7.7% right now.
Really?
Yeah.
Wow. And that's because look at the stock price. It went from 212 down to 85. So, and can they afford that dividend? Their payout ratio 97%. Let me look at a different way of looking at it. Let me look at their free cash flow per share. So free cash flow per share $4.15, $7.26 last full year. And they pay a dividend of $6.56. Wow, that's a lot. I don't know if they could afford it.
Their free cash flow payout is 90%. Their earnings payout is 99%. Simply Safe Dividends has a borderline safe score of 50 on them, which is not borderline. May sound really bad, but there's quite a few that are lower than that hasn't cut their dividend yet. So I watch Simply Safe Dividends because they do research on these companies individually. They don't rely on computer algorithms or just fluctuations in valuation. They actually dig pretty deep in their research. They did lower their score from a 60 to a 50 on May 1st and then maintained that on July 31st.
So what does a 50 mean? It means risky or not risky, or
I don't know.
with regard to the dividend, is the dividend at risk?
It's borderline at risk, but they usually catch these before the dividend cut actually happens. It'll go down to a 30 or even a 20. I think MPW is like at a 20 right now. So I still feel comfortable with the 50 borderline score on UPS, but it is starting to get a little on the edge there. Something that has to be continually watched.
Yeah. If they start to grow and really expand their free cash flow, which I think they can, I think they can kind of work their way out of this situation. And but it's, when are they going to announce next? They're going to announce on the 23rd of October. It's in roughly a month. So we'll see what they come out with. All right. So we covered UPS, we covered FedEx. The trade desk. It had a rough day today. Man, and what did AppLovin do today? So AppLovin was up. The trade desk was down. This stock has not been doing well. Down 58.49 over the 1 year, down 62% for this year. They announced not too long ago. They're going to announce again on November 6th. And these guys are an ad tech company. Now, these guys are beginning. I mean, if they keep selling off at a certain point, and was it a sell-off based on some real news? So, not seeing anything compelling there in the news. But the business is still growing. I mean, they're still growing at a good clip. If they were to have an earnings and they're growing more than 20%, I think the stock's going to do well. If they show that their decline in the percentage of growth keeps going down, that's bad news. Even though they're pretty good size, 2.6 billion revenue. That's good. Last time I looked at them from memory, I think they have good fundamentals. Yeah, they have good cash flow. They have good margins. Profits look good. And the free cash flow margins look great. What are the analysts saying about these guys? 34 analysts cover it. Man, that's a lot of analysts. And they think it's really discounted. Interesting. So they're expecting this company to keep growing. If they keep growing at this clip, this is a really discounted stock. This is a good opportunity. Let me look at their valuation. Yeah, it's so I'm growing their cash flows by 20%. Okay, that's reasonable. Here's their cash flow. First year, maybe I can bring that down to 20%. Yeah. I don't know why this stock isn't working. If they're going to grow at the revenue amount that it's growing, this is a nice opportunity. AppLovin is getting a lot of the attention. They're doing really well. They're growing really fast, but it doesn't mean that they're going to fully dominate this space. The trade desk has a good business. They're growing and they're pretty good size. They're not tiny. So this isn't a bad idea. The trade desk. When it's going to start to rise, I don't know. And boy, these drops have been horrible. You know, that 2 of them in the last 12 months where the stock just really went off a cliff. Any thoughts on the trade desk?
Yeah, it's a pretty rough looking chart. I would have a hard time because I don't take risks like this, but at least for the most part, I shouldn't say I don't take risks, but I try not to. Let me put it that way. So there's a couple ways we could look at this. The first one, if I just connect these two highs, I mean, that's actually a pretty steep recovery, and then you don't have much room to run above that. So that would be the first place I would look to draw my line to see when I would get interested. And then maybe another one is you're connecting all of these points. And if you do that, you would need to get back up to about 48 or so before I could say, you know, it might be worth taking a risk on, because then they've held this twice. So if it gets above 50, you've only got about 10% downside, but I mean, it could run back up to there and you'd have a 50% upside. So your reward to risk would be 5 to 1. So,
you know what keeps me interested in the trade desk is their revenue growth. A business that's growing 15 to 25%, that's a good business. That means they have pricing power. They're getting more customers. I mean, that's the right number, or I should say that's a very good number, especially with the business that's their size. So what's the market reacting to with these sell-offs?
the PPO or the RSI, I've seen RSIs get lower than this, but not much lower. This is,
25.
yeah, it's about as low as, it's not as low as they've even been. They've been down to 15.
They have a hard time giving away the stock.
Yeah, pretty much. And their PPO has been negative ever since this big drop, and pretty much has been sideways. Doesn't seem to be going anywhere. Accumulations at a year-long low. Let me go out to 2-year. Yeah, 2-year low. So it's really been since about right here where the market just lost interest. So that would be worth investigating. Just, why is the sentiment so bad on this one
Yeah,
right around this point? Because they just start punishing them big time right here.
I'm gonna give myself a little homework item because this stock looks like it's gonna reward investors that are in the stock at the right time. If their revenue keeps growing, this thing's gonna go up. This thing's gonna double in value, maybe even triple in value. Because you think about, look at this, this stock chart. It's been up to some really nice highs. It's been really volatile. And meanwhile, the business over the last 5 years, it was an $836 million revenue company. Okay. Fast forward the last full year, triple the size. And they're still growing at the same clip at 25%. Going back to the chart. So back here, it was a $95 stock, and it was a third the size that it is today. Well, market, okay, I'll take your lowest price, $43 a share. The business is 3 times bigger and continues to grow. Shouldn't the stock price be at least double, if not triple? You would think. Because they haven't, it's not a case of like UPS, right? Where, hey, they hit a wall, they stopped, they started to contract their revenues and so forth. No, they've grown each year. The company's gotten bigger. The margins are good. Free cash flows are good. So if you look at the financial statements, you're probably thinking the chart is up and to the right. And no, it's not. It's been abruptly sold off. So I'm going to study their earnings releases and kind of what was the story behind it? Was it a lack of confidence story? Was it, what kind of story was it? And I wasn't sharing my screen, I realized. So anyway, so I was explaining that the stock hasn't really moved over the last 5 years. It was a $43 stock. We're back to where it started, but the business is 3 times bigger with the same fundamentals. The growth rate stayed the same, mid-20s, high gross margins, high free cash flows. So, hey, I think it's worth investigating, and I'm gonna take a look at it. Yeah, thanks for bringing that one up, Ben 10. OWLT. Not familiar with that stock. OWLT. Have you ever heard of this stock, Daryl?
No, this is a new one for me.
OWLT provides digital parenting solutions in the United States, UK, internationally. So digital parents, huh?
We've had them for a long time.
What is it?
I don't know. Just give a kid an iPad.
It's too late for me. My kids are grown up, so
Baby monitoring. Okay.
all right. Okay. All right. Okay. So you got a camera, you put it in
kind of like Ring for your
the
kid.
baby room. Oh, you got a little foot brace here so you can see the pulse. Oh man. My wife would have saw this when our kids were little. We would have owned all this. Okay. All right. I get it. I get it. Okay. So we got products for little infants. The company's been around a little while, founded in 2013. Okay. Really small cap. And for the 1 year, up 83%, 5 year, not so good. Down a lot. So what's been happening recently that's making the stock go up? So we have revenues of 89 million and they are growing. This looks good. Looks like they had a contracting year in 22, excuse me. And then in 2023, they had another contraction. And then boom, they're beginning to grow. That looks good. So growth looks good. They're not going to have incredible profits. They're going to be okay. Like 40 some odd percent. No, 52%, excuse me. They're losing money because they're making a physical product, right? So it has to be manufactured and it's not as profitable as like services or software. And they're not making any free cash flow. So it's going to be hard to value this one for me. It did have a very good day and it's had a very good year to date. Yeah, it was up almost 10%. Wow. And it's a very small cap. And you could have picked up this stock not too long ago at $3 and be sitting pretty. Any comments on OWLT?
Well, they did have a good recovery after the tariff announcements, but up until that point, they were almost flat through September all the way through March. They do have a rising 200-day moving average, a declining 50-day, and a declining 20. They are trading above both of those two moving averages over the last couple of days. So it is on somewhat of an uptrend, and this dark purple line here is just a 5-day moving average. So it's rolled over and started going back up. Wow, when this one gets going, it gets going, at least on this 1 year chart, and it stayed overbought with the exception of just a couple weeks here. It stayed overbought for almost 2 months. That's one of the longer ones we've seen here in the last couple of weeks that we've been looking at these. So if I were just trading this, I'd be watching that PPO when it crosses over and just writing those and consider getting out, when it trades down or it moves down below a chandelier exit, which I would have to talk about in detail if anybody was interested in that. That's what I use to get out of stocks. But you can also use this PPO just when they cross over if you're just wanting to trade it. The accumulation looks like it's been in distribution mode, which is kind of interesting. Yeah, it's been in distribution. There's been a lot of distribution, so the cumulative total is actually nearly at a 52-week low.
Interesting.
Yeah.
So looks like SoFi, this is this second or third comment I've seen on SoFi. So let's take a look at SoFi.
Yeah, SoFi
It's got
chart looks great.
Yeah, I was saying the chart is going to look great. And to my surprise, it's still only a $33.66 billion market cap because it's been having a terrific year. So I would have guessed it was 100 billion, maybe higher. It's a revenue of $3 billion. PE is getting a little high. And the price targets are, the analysts can't keep up with this stock. They are growing well. And do I have a valuation on SoFi? I have them underwater. I think the stock's priced 27% too high because the stock's just been flourishing. And that's where I'm at. I think they're 27% too high. Can you show us some charts on SoFi?
Yeah, it's looked really good since it came out of the COVID tariff announcements.
Mm-hmm.
It's run up 216%. All the 3 moving averages are all up and increasing, so that's usually a really good sign. RSI is sitting right at 70. Even when it went into overbought condition, it resolved that just through some consolidation and a couple of days of some fluctuations, 3 days worth here. And that pulled the RSI back down. And since that time, it's just gone up and to the right again.
Mm-hmm.
PPO has been in bullish territory since April 28th. It's had a few crossovers in bullish territory and kind of leveled out. So that's one thing that I would be a little concerned about is negative divergence. So you have the price going up and the momentum going down. Not
Mm-hmm.
that that's the end of the world, but I would keep an eye on that if I owned it.
So the price is going up and there's fewer buyers. Is that what I'm understanding?
Yeah, the price momentum is slowing down. Maybe, I don't know about necessarily fewer buyers. That could be, but it's the momentum is definitely slowing down
Mm-hmm.
while the price continues to go up. As long as it stays in bullish territory, that's a really good sign. It hasn't had a peak, an RSI below 50 since April. Money flow looks really good. Accumulations at a 52-week high. Outperform the S&P, outperform finance, outperform consumer finance industry group, and that industry group is outperforming the S&P by about 6%. So it looks really strong as far as the charts go. A couple of times it's come down here and touched this 20-day moving average, and if you're just following the chart, those are really good buy points when it hits that 20-day. If it's in an upward trajectory and it does pull back to those 20-day moving average, normally I would use a 21 exponential moving average for trading purposes. I use the 20-day simple because that's what the majority of investors use when they're talking simple moving averages. So that's what I usually have on my charts for these live streams.
Could I ask you for a big favor? And can you look at Robinhood?
Sure.
I'm almost afraid of what you're going to say, but let's do this because it's done so well. I'm up 600 and like 20% on this stock, and I'm like, oh,
No,
I just don't.
This one
I don't
looks
know what you're
really.
going to say.
This one looked really good too. So it did pull back and touch the 50. I would have started getting worried here a little bit, but if you're up 600% and it's down 17, you're not going to sweat that too much.
No.
But it came down and touched the 50 and just lifted right back off of that, and it's above the 20, and they're all upward sloping. So RSI looks good, PPO looks good, accumulation looks great, money flow looks great, and it's in a strong industry, and that industry is Right? It's outperforming its industry, and that industry is outperforming its S&P 500. This looks really good from a charting perspective.
And you know what has happened with Robinhood is it's a stock where the valuation has continued to change for the better because they got bigger and they keep growing fast, right? And it's a sign of a very good business because they're adding new businesses and expanding. So it's creating a bigger company. So I cover every financial release, and each time I cover it, the numbers get bigger and the valuation gets larger. So I actually still have a discount on Robinhood. I'm not buying any more shares because I own plenty. But this one has been interesting. It's a sign of a really good business because even the great stocks, right? Like even like a Meta, when they IPO'd, and if you studied their financials over the first year, maybe the second year, you're like, wow, this is a good business. But you didn't think, oh yeah, someday they're going to be $1 trillion market cap. No, but if, year after year, they just kept getting bigger, making themselves more valuable. So Robinhood's looking good. Glad to see the charts are good. And coincidentally, we talked about early in the stream, we talked about Polymarket and how Polymarket had, and you know what? It had the right prediction on FedEx, right? Were they going to beat or were they going to miss on earnings? And a lot of people that were betting were correct up until this morning. And then people got scared and like, oh no, I think it's going to be bad. And then boom, 100% sure now that, yeah, the earnings are good. So this whole predictive, market, Robinhood wants to do this on their site, and they may already be doing it. So they're going to do this on their website. So if people want to bet on an outcome like, hey, who's going to win the football game tonight? You could do that on Robinhood. You can do that on Polymarket too. I'm pretty sure I don't know who's playing tonight, but there's a football game on tonight. Is it the Yeah, it's right here. The Dolphins and the Bills. Now this is going to be one-sided. I think the Bills are pretty darn good, and the Dolphins are not very good. So I think this one's going to be over in the first quarter. So you can bet on a football game on Polymarket, and this is what Robinhood wants to do on their website. I think it's a really good idea for Robinhood, and one more way to keep your customer engaged. They can have a little bit of fun on the Robinhood website and do well. So here's Robinhood, $107 billion market cap. They've been added to the S&P. Their revenue, $3.5 billion. They're about the same size as SoFi. That's why I was surprised that SoFi was only $33 billion, because SoFi was like 3 something billion in revenue. PE about the same as SoFi, a little higher than SoFi. And they are priced a little too high according to the analyst. I don't agree with them. It's been a good stock. And it's given investors opportunities like, hey, even very recently, this is the pullback you were referring to. It pulled back and there it was. And on member calls, we talked about Robinhood, and, other members asked me, well, where's the valuation? I was like, hey, it's discounted. I'm not going to buy any more shares because I own too many, but that's where I'm at with my research. And it's gone up since then. So that looks really good. All right. So moving along on the comments, looks like there is some news on OWLT that their cameras are getting hacked. You're welcome, Ben 10 on UPS. Max, good to see you. And we got a lot of new people. Good to see some new names. If you're a member, I cover the stocks. If you're not, you buy a $5 super chat, and then I can cover your stock. Let's see here. Just reading the little J. Good to see you. So Visa, how is Visa trading these days? So Visa was down today. Okay. Year to date, it's up 7%. 1 year, 16, 5 year, 65. Now, for a while, this thing was like a real performer. Like this section here, doing great. Big cap, 651 billion, revenue of 38 billion, PE ratio of 33. Analysts think it's a little discounted. And they continue to grow impressively, 11% on a pretty big number. And so far, we're not seeing how potentially like stable coins or other alternatives to the Visa network are taking business away from them. I don't think that's that's showing up in the numbers just yet, but it might be a story that impacts their stock price. If we start seeing stable coins really get used for transactions and alternatives, like buy now, pay later is also a competitor to Visa, because the buy now, pay later, what they're trying to do is they'll go to a merchant and say, hey, you can offer our checkout process. It's going to increase sales because your consumer is going to say, okay, yeah, I want to buy that $1,200 item and make 4 payments. And the buy now, pay later company, what they're willing to do is we're going to get 3%. And then that 3% is in essence their margin. And the customer has to pay back make those 4 payments like in 6 weeks. It's not like 6 months or 18 months. It's 6 weeks. So if they're doing this and turning, this type of volume like 6 to 10 times a year, it's 3% times 6 to 10. Now we're talking some pretty good, meaningful margin. So the buy now, pay later program is working for some companies. And if they're very successful, it's going to take away business from Visa. We'll see if it happens. So Visa, I don't know if I have a valuation. If I do, I've never valued Visa all that high. It's been kind of a safety stock for many. I don't have a valuation. I don't know if you have any charts on Visa.
Yeah, you're specifically asking about the last 3 hours trading day. So I can definitely see a big spike. These are 15-minute bars on an intraday chart. So I can see a big downward spike at 1 o'clock. I went over to Seeking Alpha, and I don't see any news today. I'd have to go to Yahoo Finance or maybe some other places to see if something that was announced at 1 o'clock. And I would also need to compare it to, I could probably compare it to other credit card stocks, see if there was something that was in common with them. But you're right, there was a big spike down, and then after that point, it just kept trading down. So there was let me go to like maybe 5-minute bars. We can see a little more resolution.
Yeah, I'm not seeing any stories on Visa.
You're not?
No.
So I do see a big drop here right at 1 o'clock. I mean, it was right at the top of the hour. And then it dropped the next 5 minutes. These are 5-minute bars. And it dropped the next 5 minutes and then started recovering for about 15 minutes. And after that, it was Katie bar the door. So I don't know what happened. I don't see any news. Victor's not seeing any news, but something happened at 1 o'clock.
As I speak, in after hours, the stock is up 0.17%. So there isn't any bad thing happening yet.
Yeah.
All right. Thanks for asking about that. All right. Good. All right. We covered, I think, all the comments. Thanks for tuning in, everybody. So I think we've made it to the end here. We covered FedEx. We covered their financials completely and valued the stock. And just to recap on UPS, let's see what the stock's doing at the moment. I'm sorry, FedEx. May have said UPS. So the stock is up 5.79 in after hours trading. So it's having a good evening. The market liked that their financials. My summary is they're growing top line revenue by 3%, which is good because their business was flat. That's a sign that they're going to start to grow by a little bit. And the forecast also look good, that they're going to grow single digit, but it's going to be growth. And their free cash flow was better than the previous quarter. That's also positive. And when I valued FedEx, I got a nice discount available on FedEx. So the market's pricing the stock up. I have them as, based on the price that they closed at today, a 34% discount on FedEx when I value the business based on cash flows as well as their earnings per share. And their peer company being United Parcel Service, they're discounted by 38%. So pick your favorite color. If you like purple and orange, go FedEx. If you like brown, UPS is your option. All kidding aside, both of these businesses, especially UPS, has been on this downtrend for like 3.5 years. At some point, these businesses are going to bounce back. These are just really important businesses to our economy. Amazon's not going to deliver everything. These guys are going to deliver everything that Amazon's not going to touch. So FedEx is discounted. And I don't know if you have a summary on charts on FedEx before we conclude.
We can look at it once more. Yeah, they're definitely on a downtrend because the 200-day is declining. Let's see where the 50-day is. Step out a little bit here. Everything is kind of run together. The 50-day is declining, and the 20-day looks to be declining. With if tomorrow it continues trading at 237 or 240, it's going to be bumping up against the 200-day, which could be a little bit of resistance that it's going to have to fight off tomorrow. And the implied move was about 8%, so I don't expect a move much bigger than that. The volume today was pretty high. Going into the earnings yesterday, it was higher than the 50-day moving average, but yesterday was a sell-off day. The RSI is right at the midpoint. PPO is right at the midpoint, so nothing really to get excited about there unless it breaks to one side or the other, which I would expect tomorrow. We're going to see an increase in both of those. Accumulation has pretty much been flat, oscillating from about where it was at the beginning of a year ago, not the beginning of anything, just 1 year ago. So anyway, it's got some work to do, but I don't see anything terribly frightening here, especially if you were just now thinking about getting into it. It does have a lower yield than UPS does. I wish I'd have been buying UPS at this price instead of the price I actually bought it at, which I'm afraid to even tell anybody because I show you guys a lot of these charts.
I've only been seeing green on your charts.
Yeah, well, I'm going to show you one that isn't like that.
Whoa.
And not because I don't want to show them. It's just nobody asks about these companies. So this is one where I've totally just fallen out of bed on. And this was really before I started implementing my risk management process that I have in play right now. I would never let myself get into this position. In 2022, can you guys see my screen?
Yeah, it's a little
Yeah.
small, but I can see it.
Okay. In 2022, I really didn't have a risk management process in mind, and I was a dividend investor, and I was kind of the mindset that a lot of people have. As long as it's paying their dividends, I don't care what the price does. Well, that's a big mistake in the long run. It kind of makes sense because prices recover and they are paying a dividend. They have been ever since I've owned them since 2022. But dividends don't cover a 41% drop in the price. So I don't adhere to that philosophy anymore to the same extreme that I did in 2022. In 2022, it actually, because that was the year that I had the most dividend payout. It was huge that year. So anyway, that's what solidified that thinking in my head. I've since changed that, and this is one of the reasons why. I don't want to take a 41% loss on a 7% dividend. So this is definitely, and I covered this actually in a video that I did because I talked about the process that I use for risk management, and this was in my failure category. I gave 3 positives and 3 negatives, and this was in my negative.
Can I ask a related question?
Sure.
Do you think about harvesting losses near year end?
Not in this account.
Okay.
I'm going to pay ordinary income no matter what in this account.
Okay.
So anyway, this, and I explain it in that video. You can go find it in my YouTube page if you're interested in why I changed my philosophy and don't make that same mistake again. It's like Victor said, most of them are almost all green. I've increased my win percentage from this one from a 0 to nearly all of them being above 50 at this point. So I've definitely changed my thinking there.
All right. So we have a question. It's going to be kind of just a, kind of getting your thoughts kind of question. I'll lead since I was able to read the question first. And so we have some younger investors. So before we close it out, can I share something, to that younger investor? And this might be a good idea as we do streams, is kind of close out with, maybe some suggestions or just a little bit of a reflection. Hey, if I'm 57, right? So I like to say, if I can go back to my 22-year-old self with my 57-year-old wisdom, what would I say? Hey, do this. Or if you recall, Back to the Future, you remember the original?
You bet.
And was it Duff got a hold of that magazine that had all the predictions for the scores for the football games and the sports, and became a billionaire or millionaire? So what wisdom would I give my younger self? That's what I'll kind of make it a theme as. Given the market's been doing great. Now it's good to, appreciate that the market, let me try to get the graph going here. So we're having a very, very good market over the 5-year. Okay. This market's really, really good. And there's, I think there's a lot of success, and there's some success that's kind of built outside of the lanes that I invest in. And there's some success that's built in the lane that I invest in. I like looking at companies. I like believing in the businesses. I like to look at their financials, and I like to make sure that I feel like that business is worth that stock price. And I feel like I'm getting everything I want. I'm getting a business that I really like. It's an exciting company. I'm buying the right way, which is I'm buying, a discounted stock. I've got my recipe for success. My word of wisdom to the younger investor is don't get out of your process. There's going to be a lot of stories of, XYZ stock, like, the space stocks. Oh, Rocket Labs is up, 500% in a month. That's super neat, but it's not in my process. I can't, don't go chasing a bunch of shiny objects is the advice. Figure out how you want to invest and start really trying to perfect your process. Really learn how to do your form of investing better, because the the better you get, the more long-term money you will make, the better returns you will make. You'll have a greater sense of control. But if you go chasing shiny object to shiny object, first, when the music stops, you're going to see a lot of those shiny objects fall really fast. And then you're going to be like unaware or lacking the understanding of why did that stock go down? It was flying high and now it's super low. I've been there. When I was 22, that was 35 years ago. So that was in the 90s, go 90s. We had like crazy internet stocks. We had the Y2K scare. We had software stocks flying up like crazy. And it was kind of, there was a lot of shiny objects then. And I was younger and I bet on some of them. And I lost on one stock, I lost all my investment. Sun Microsystems really was a big loser. I did have some winners as well. I bought Microsoft way back when, and I knew that was a real business. So that's what I would give the younger investor is, the sooner you figure out, here's how I'm going to get really wealthy over the next 20 years, 30 years. This is going to be the process, right? I'm going to be fundamentally a good investor following this type of philosophy and investing approach, and to just dedicate yourself to that. Don't get distracted with shiny objects of other stocks that don't fit stuff that you should be invested in. Those are the words of wisdom I would give you in this market where the market's just doing great. It's doing phenomenally great. And to give you one example, Broadcom, I was an investor in Broadcom. I sold Broadcom. I'm not an investor of Broadcom. I actually think it's way overpriced. It's way, way overpriced. I think it's at some point going to punish investors. And it's out of my process. So that's what I would put out there. Anything you would share out there, Daryl?
I think you pretty much summed it up, but I'm going to give it from a little different perspective, because the younger me was a dad and a father. I was married for 35 years to my first wife before she passed away with cancer. So that was my focus. But I remember as a young man at 21, when I started my first 401k, there was an older gentleman that sat down, because we didn't have Discord and YouTube and everything back then. So trying to find someone that had the least bit of interest in stocks was hard. But this guy just sat down with me and he said, Daryl, get into the 401k, put in there as much as you can out of your salary each week. Never stop, never pause, never take money out of that account. And when you are ready to retire, you'll have enough money to retire on. That was the best advice I ever got, because that's exactly what has happened. I've been retired for 5 years, and my portfolio is paying for my retirement right now because I am not taking Social Security yet. I am living off of my portfolio.
Good for you.
So
Yeah, definitely on your 401k, always the minimum is your company's match. They
exactly.
match the first 6%. That is like, that's the universe giving you money. Please contribute at least 6%. If they match the first 8%, whatever percentage, you minimum. And then if you can do more, great. Max it out. Give yourself a goal each year. And I know you have to have your career started and you start making some good money, and just max it out. Max it out as many times as you can. If preferably you get into a career where you're maxing it out every year, and then you amass a very good fortune. So we're going to look at Wendy's. Looks like Falls Grave would like to look at Wendy's. Now, I am certain that, I don't know if Wendy's is going to be a good buy, but I am certain at the end of this little segment, I'm going to have a bigger appetite for dinner. So let's do this. Wendy's is a restaurant, and it's quick serve. Okay, we know what they do. They have a very tasty hamburger. They have a very tasty menu. And over the year to date, these guys are down 41%. 1 year down 46%. And then not a very good picture. Let's see if their fundamentals are matching what the stock market's been doing with the stock. So the stock market, this is priced at 1.8 billion. Revenue is above that. Low PE, high dividend. Okay, we'll see if they can afford that dividend in a bit. Analysts think it's discounted. Now, they have been growing. So that price, the stock chart, it's not following kind of like I would call it the health of the business. The business is growing. So they are growing. That's good. Let's look at the quarterly. Last 2 quarters have been contracting. Not by a whole lot, but they are contracting. This could be a sign of like, hey, what's going on? Like, people are not eating at Wendy's. All right. So they're growing a little bit. Last 2 quarters contracting. They are profitable and they have good free cash flow. Their free cash flow per share is $1.28. I'm going to compare that to their dividend. Okay. Gross margin is 35% to restaurant. Understood. You have to buy the ingredients, pay for your direct labor to cook the hamburgers and the fries, and somebody take the orders and stuff. Profit margins, those are decent for a restaurant. And then the free cash flow margin's decent for a restaurant. Okay. So that looks good. Let's see what the analysts are saying. And then I want to look at their debt level. Debt's going to be very important for a company like this. 16 analysts cover this one. Okay. And they think it is nicely discounted based on earnings per share. And it looks like their forecasts, and a number of analysts are commenting on the forecast. This is good growth. This is a restaurant. It's hard for these guys to grow. And they're going to grow single digit, but it's going to be growth. And their profits are going to grow faster than their top line growth. Good news is, from the inflation data that I'm just high level, remembering, we don't have super high inflation like we had a couple years ago, which was making it very difficult on restaurants if their ingredients were going up in price. They don't like to move the prices on the menu all that fast because they could lose customers. It could be a lot of long-term pain if they move prices. So these guys are going to expand profits in the future. So that looks good. So earnings per share looks good. Let's double check on debt, because debt could be a very, very big problem for a business of this type. They have $281 million of cash and $4.1 billion of debt. Okay. What's their debt to EBITDA? Debt. Oof.
Oh,
No bueno. This is not good. It would take them close to 8 years to pay off their debt. This should make me walk away. It's like, oh yeah, I can't have that debt level. If they have a combination of like stresses on the business, you know, maybe the the uh, uh, the beef prices go up, and they're like, man, that really dried up our cash, and they had a couple other bad events, and they find themselves kind of behind the 8 ball. It's a pretty ugly situation where they may have to restructure bankruptcy to get rid of some of this debt. Then it's going to get really ugly. So I don't like that number at all. If it was like 3.5, maybe it's kind of like, okay, it's not the worst number, but 7.92 is really high. That's really high debt. And that's why I check.
It looks like they don't know how to manage paying out a dividend either.
Yeah, and it's a double negative. Is if you have this much debt, you don't pay a dividend. You need to run a business, really like all your employees, their means of, making a living is dependent on your decisions. You keep that dividend, you pay off your debt so you can have a viable business that your employees are going to be employed at, that your stockholders are going to be in a better position with, but don't pay out a dividend if you have that much debt. So I could compare their free cash flow to the dividend rate and say, okay, well, they have $1.28 in free cash flow and a 56-cent dividend. So you could say, well, they could afford it. Yes, but after looking at their debt, it's like they shouldn't be paying out a dividend. They should stop the dividend.
And it was $1 last year, so they've cut it. I'm looking at it was 6 cents 10 years ago, and then 8 cents, 10 cents, and it ran up to 25, and then it's back down to 14. It's just all over the place.
So let's look at the debt level for the last 5 years and see what's been going on. So last 5 years, we went from 2.2 billion, and these leases as well, right? So it hasn't grown a ton, but they should have been lowering it. Okay, it got really high in 2022. And when you have really low interest rates, it makes businesses kind of sometimes do the wrong thing. It's like, oh, yeah, let's go ahead and borrow the money because we can borrow it at 3%, 5%. Man, it's super low. Yeah, it's fine. Then interest rates go up and you're like, oh no, now we're going to have to pay 8%, 9% on that debt. That's really eating away at our margins or net income. So they have that debt level. And when we look at their income statement, we're going to see that they're going to be paying an interest expense. So legal settlements, interest expense. So they're paying all this money in interest. So it's eating away almost probably about 40% of their operating income goes to interest. It's almost like, it's a term that's, I wish I could find better words, but with high debt, a business becomes a slave to debt. They're just paying debt. It's like, it's like your personal life. If you have 20 credit cards maxed out, you're going to work just to make money to send it into these credit card companies. You don't want to live that life, and businesses shouldn't exist in this manner. They should reduce their debt, be disciplined so that they could take on really interesting projects, maybe new store locations where they could grow faster and make more money. So those are my comments. Do you have any charts on Wendy's?
Yeah, it's pretty pitiful. I'm looking at a weekly chart here, and they're trading almost at their COVID lows. So, I mean, just look how good the market has performed over the last 3 years.
Yeah.
And then ask about Wendy's. I would, this looks bad. It just doesn't look good to me. These haven't performed well.
Yeah. As a youngster, by the way, I worked at UPS for one winter. It was a great experience. UPS is very military like and it's very rah, and you're direct manager. So that experience to this day was a very positive impact. I also had jobs working fast food, right? I was a youngster and I wanted to make some bucks. Um, and I could tell you, man, I worked really hard. Everybody at that restaurant worked incredibly hard. And it's good that, that work ethic exists, but you count up like, man, we would sell, I worked at a Taco Bell and man, you'd sell a burrito. And back then it was like, geez, like 50 cents. And it'd be like, we did all that for 50 cents. Now a burrito's, I don't know, $2, $3. Even that's really low. And I, decided, man, I got to find an industry where, let's say, I work with my team, we do a transaction and we make a heck of a lot more than $3 per burrito. Instead, maybe we work on a project and it takes a while, it takes a lot of effort and we get $500,000 per transaction. Now we're talking. So back to Wendy's as the example, we get to pick whatever industry we want to invest in. And like in career, we could pick Wendy's, we can pick Meta, we can pick SoFi, we can pick Robinhood, we can pick Rocket Labs. There's no rule that you have to buy a restaurant stock. I don't own any restaurant stocks because the fundamentals just are not good. And going back to my experiences as a youngster, I never went to go back to work at Taco Bell. I had my experience and I was like, you know what? I want to do something different. Went to college, did something very different. But even in my college days, I ended up finding a job that I thought was better and I got paid more money. Even at a young age, I knew, hey, I could probably go to a different industry, make more money. So same applies as investing, right? Let's look for great fundamentals. Let's look for really profitable businesses that are growing, because that just means when they're 2 times bigger, they're going to make twice as much, profit. The cash flow is great today. And if they're growing, they're going to make that much more in the future. They have a balance sheet that's great. They have no debt. They can go acquire other businesses. They can grow their business. They have the resources and the capital to grow as fast as they want to. So that is Wendy's. Thanks for asking. Hopefully you found the research interesting. So that was Falls Grave. Thanks for asking about that. All right. So yeah. So there's a comment from Mike. All right. Thanks, Mike. I appreciate that. All right. So on that sentiment, I got to run. This is a great stream. Thanks, Daryl, for tuning in or for co-hosting with me. I really appreciate it.
Yep. Thanks for having me, Victor. I appreciate it.
Yeah. And thanks everybody for attending. We're going to stream tomorrow morning in the morning and see how the day goes. My best guess is, we had a great day today. So I'm not going to be surprised if we have a down day tomorrow. But you know what? Year to date, I'm doing great. Today's gains were tremendous. If we have to give up some of the gains tomorrow, so be it. Not hoping for it, just expecting it. And if you tune in tomorrow at 9 a.m. Eastern, we can talk more about stocks and see what the market's doing and see how the market's going to trade. With that, everybody have a good night. Daryl, thanks again. And have a good night.
Thank you, Victor. Thanks, everyone.
See you guys.